property market's going to drop by 40% in the next 12 months. That is what this article right here by 60 Minutes said in 2018. One of the experts behind that article was Martin North, this guy here. And we were all laughing. We didn't see it happening. Since then, we obviously all know that the property market has done 30%, 30%, 30%, 25% here, year on year for quite some time now. So if you followed that advice as an investor, you would have had quite a bum steer and you would have messed up quite a lot. But it turns out that Martin North, the guy behind this a portion of this article, actually had some other scenarios. He was kind of steered a little bit wrong by 60 Minutes and portrayed in a bit of a shabby light. And that's kind of why we wanted to get him on, because he is the founder of Digital Finance Analytics, and he looks at the data. And that's what we love to do in this show. And we don't always want to get pro-property people on. Not to say that he's not pro-property, don't get me wrong, but we don't want to be just saying, we don't want an echo chamber of property is always going to go up, because it's not going to continue to go up forever and ever and ever at these crazy paces that we're seeing. So we wanted to understand the fundamentals behind that. What is the employment? What is the infrastructure? What is the vacancy rates? What is the supply and demand? What is all of this stuff, and how does this all correlate and connect? And at the end of it, he actually goes through some predictions, and that's why we wanted to get him on, to see what are his new predictions and how are they kind of factoring in property prices, and what is that going to look like. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Australia's largest property investment community with over 75,000 property investors. And each week we interview top property experts, and we want to unpack their lessons, their learnings, and their understanding, so that we can all become better property investors and go find out where the opportunities are. And that's what I loved about this session is. So let's jump into this session and see.
One of the things I worry about is when people think about buying property and then turning it over very quickly, a few months or a year or two. The entry costs for buying property, things like stamp duty and transaction costs,
really
means you should be thinking of a 5 to 10 year horizon, in my view, if you're actually going to build a portfolio of properties. Now, okay, there are those who say, well, what I do is I buy cheap and then I do a renovation and then I sell on. You might be able to do that, although in the current environment, the costs of
not property advice.
People, I cover this for
not
now.
financial advice, not property advice. The fact of the matter is the costs of construction have risen by about 30%. So if you are going to try and buy one of those and then, renovate it and sell it, very hard to do at the moment. So a lot of people don't think about the total costs of their investment. And interestingly, if you take a long-term view, and I've done very well in property over the years, I've bought the right types of property, I've held it for a reasonable length of time, and I've been able to make capital returns. But a lot of people that I speak to in the investment sector have made really bad decisions, and they're looking over the too short a term and are relying on the tax breaks and the tax benefits to be able to actually offset income elsewhere. Right? Now, I don't believe that using property as a tax break alone makes a lot of sense. So what I'm trying to say is there's a more complicated picture here of when you actually think about wanting to construct a story around property. In my surveys, what I discover is that a lot of those people with big mortgages have zero savings. They're actually relying on credit cards. They're relying on buy now, pay later. Whereas others, those people who don't paying a mortgage and have no debt, they're the ones who've been saving. So even now, there's an unequal distribution from those savings. And so again, when you start unpicking this, what you realize is that not everybody is in the same boat. Now, when you actually are going to talk to the bank and the bank says, okay, how much you want to borrow, they'll look at your income, they'll look at your expenditure, but the lens they use is a very narrow lens. They basically make some assumptions about what a typical person would spend.
The HEMS,
Yeah, the HEMS, right? It's not actually your profile. It's actually what a typical person would spend. And in fact, that went through the courts, and ASIC basically took Westpac to court, and Westpac was allowed to use the HEM as a measure of affordability. So
The Wagyu beef and red wine case.
yeah, exactly right. So when you actually look at it, what you discover is a lot of people were able to get mortgages that they could only just afford at 2%. Right now, of course, with interest rates significantly higher and mortgage rates at the 5% or the 6% and the 7%, not surprisingly, quite a few people are struggling. But
So-
it's not everybody, right? There are others that are doing absolutely fine.
Well, that's what I'm interested in, is that not everybody. So what segment, how do you think about it and segment the market out? Is it an age bracket? Is it a demographic bracket? Is it a price range bracket of like people who've bought a house with $1 million of debt, as their PPOR? They're the ones that are struggling. Like, can you define this struggle street people?
Yeah. So what I do is I segment my households into different pools, from young growing families to professionals to older families. So I use a combination of age, income, and other factors too. I have about 12 or 13 different segments, right? And then I look at how each of those segments are behaving, because if you think about young growing families, they're predominantly first-time buyers. A lot of young growing families are really struggling. About 80 to 85% have a cash flow problem at the moment, and they are really really difficult to get into the market. They're also competing with property that effectively property investors are quite interested in buying in as well at the moment. So a lot of first-time buyers are a bit squeezed out. And in fact, despite the fact that first-time buyers are actually active, most of those, more than half, are only active because they're getting money from family, the bank and mum and dad. So that's the only way they can get in. If not, then you can't probably get in. So first-time buyers, some are excluded. But if you then think of some of those other groups, so the more affluent professional groups, the ones with the big incomes, they're buying really freely at the moment, and they're actually being greeted by the banks. So ANZ recently changed the lender's mortgage insurance parameters for people borrowing more than $2 million. That says, well, you don't need. We'll give you more. So the banks are now chasing
5% loan, wasn't it? You could essentially.
Yeah. Exactly right. So they're actually trying to support that particular group, because they believe that group still has capacity to borrow, capacity to spend, and are buying big. So that's one of the reasons why there are some differences in the market.
What do you mean by the property market's broken? Break it down simply for us.
Here's the thing. When I talk about property market is broken, the normal rules of supply and demand, which is what you're talking about, are still in play. So the basic economics are there. But the question is, how much demand is there? Well, demand is massively high because of very high migration. So I would argue that one of the factors that's really messed with the property is much stronger the migration than anybody expected. We talked about those numbers earlier on, right?
Yeah.
The second thing that we've got is that the typical borrower, if you go back a couple of decades, would be borrowing around 3 times gross annual income, maybe a bit more, right? Today, the typical borrower needs to borrow about 10 times gross income to be able to get into many markets, which means that rather than actually putting 20 to 30% of their income, they're now having to put 40, 50, 60, or even 70% of their income to go buy property, right? What that does is that then puts pressure on those households, which means that it breaks then their ability to be able to spend elsewhere in the economy. And so the broader economy gets effectively negatively impacted by the fact that they're spending way more than they ever did on just trying to get somewhere to live. The third reason why it's broken relates specifically to the rental sector, because we've had a lot of people coming in, because the supply of rental property is a lot lower. We talked about investors leaving, and investors are still leaving in some places, means that you have to pay a lot more to be able to find anywhere to live. You stand a significant chance of having your rent put up by 10 or 15% over the next 12 months. And many people are then panicking about what they're going to do about that. And I've seen quite a few people in the rental sector say, I need to try and buy something. I'll buy anything just to get out of the rental cycle to be able to actually try and get more control. And they then go and buy a really bad property in the wrong place for the wrong price. And again, they get caught. Or another example, banks, of course, are meant to lend responsibly. But there are many examples where banks have extended significantly more credit than households really should have been able to get. And what that has done is that has inflated the bank's balance sheets, which means that they're able to report bigger profits. And it also means that they can then lend more. So there's been a complete cycle here, a debt-driven cycle as well, which has pushed property prices back. And if you stand back and think about it in absolute terms, what is the relative fundamental value today relative to 20 years ago? Well, it's about 3 times what it should be. And you could go on a debt income ratio, you can go on the cost of construction, you can go on all sorts of different measures. So in other words, property is too expensive relative to other factors, including income. And that's the problem. So people will still want to buy property. You know, the Australian dream is to own property, but in so doing, they're now getting more and more of their finances boxed into property. And I regard property as a bit of a black hole. It's sucking more and more of people's income, more and more of society into the property pool, which means that the overall economic structure of Australia is being shrunk down and down and down. It's basically mostly property, plus, of course, the mining. So, in fact, our economic base is shrinking. And just to give you the final sort of kicker, if you go back 2 decades, 2/3 of bank lending was for business investment. Today, it's below 1/3. 2/3 is now just to support the property market and allowing prices to continue to accelerate. So that's the broken nature of property, right? It's a structural issue for the country, and it can't go on increasing and increasing and increasing. I would argue that the rate that we saw over the last 2 or 3 years was completely explicable by the ultra low interest rates, all the government stimulus. We've not got much higher rates now. Rates will come back a bit, but they'll never get back down to 0.1% unless we've got a major global financial crisis, which means that the rate of acceleration of property growth is going to be slower in the next 2 to 3 years ahead. And that means that the assumptions that people made about the growth prospects for property might well need to be questioned. And that's why I would argue that it's not completely,
hit on a good point.
It's not normal.
What are your thoughts on the policy, like some of these policies that are coming out now, like rent freezes that the Greens are talking about, the scrapping of negative gearing? Like, what are your thoughts on some of these more larger policies that what are they going to do?
So rent freezes tend to not really solve the problem in the long term. It tends to maybe stick it for a little bit, but it's basically a supply demand problem that you've got to address. The reason the Greens are doing this is because there's an election coming up, and the Greens have realized that there's a 30% of the population who rent that they can directly address. So you got to understand that this is a political play to get the Green vote up at the next election, right?
Yeah.
And it's interesting. I mean, there are some rent controls in Canberra, and there have been, some little tweaks there. So rents have not risen quite so high. But if you look at the Canberra market, it's still pretty wrecked at the moment. So it doesn't necessarily solve the problem. And a lot of the other initiatives. So the one I thought was amazing. Did you see from New South Wales? Was they say what we're going to do is we're going to buy properties that already have been built from developers. Now, again, you've got to understand this is a strategy that the developers have been arguing for a long, long time. So the government basically is now handing out more money to developers. Now, that's not a good thing, because essentially that's not necessarily helping to build the right types of property in the right types of place. But what it is doing is bailing out the developers again. And that's my problem. A lot of the policies that are actually developed at the moment are supporting the banks or are supporting the developers or are supporting the big end of town. Sidebar, same with the gas industry. We're paying 5 times what we should be for our gas in Australia, which is stupid. This is bad government policy. So again, my example, my view of the world is the reason that property is broken is because policy is broken, because politics is broken, and nobody wants to talk about these big picture issues. Everyone wants to talk about, well, we'll build a few more over here, or we'll give people another $20,000 to buy over there. That's not solving the problem. That's just
creating more capital.
It's actually creating more pressure later. It's just pushing it away. And what we're doing is we're creating an intergenerational problem, which is going to take years and years and years to solve. And the result of that is, if you are in the fortunate position of owning lots of property and you're doing quite well, then you'll be fine. And people don't want to see property prices fall. But there's a bigger and bigger proportion of people who cannot get into the property market, will never get into the property market, will never own property. And as a result of that, they're having less kids. They're not actually available there to work in the areas that we want. And it's creating significant issues. Again, it's broken. One of the things, the reason that I founded Digital Finance Analytics and why I do my shows is to help raise people's understanding and intelligence around financial matters. I am astonished how little people understand about the basics of finance, even from simple ideas of compounding through to the idea of, when you buy a property, what is the process you need to go through? The number of times I see people buying property and doing less research than they would if they were buying a new refrigerator online. It's horrendous, right? Yeah. So there is a really important space and place for better education. And I think education of kids, but also adults too, frankly. One of the things I try to do on my show is to help people understand some of these critical issues that are going on, because there's a very important education. The other point there is we've got to hold our politicians to account. At the moment, we're not doing that, right? What we're doing is we're sort of saying, it's sunny down the beach, we'll go and sit at the beach and just enjoy ourselves, right? We should be actually forcing our politicians to come clean about what they are and what they're not doing. Because if you talk to politicians privately, as I do quite often, they acknowledge that the system is broken. They acknowledge that the Treasury's demand to let more people into the country to support the GDP. Real GDP is almost zero, but zero GDP per capita is negative. It's been negative for 5 quarters now. That's not good. So we've actually got an economic situation that's disastrous because of bad policy. We've got a housing system that's actually disastrous because of bad policy. We've got an education system that doesn't do the right thing for our kids and for those to make good decisions. So all of those are the big picture issues that need to be tackled if we're going to solve this problem. We can, and Australia has the theoretical capacity to be a brilliant place to live. But the danger that I see is that we're going to foul the nest. We're going to build really cheap, bad property. We're going to bring loads more people in. We're going to make it less and less affordable to own property. And even those property investors who actually hold property investment at the moment will decide to get out because they can't make returns. It's a nuts situation that we've got ourselves into. It's disastrous. And yet our major politicians want to talk about nuclear power and they want to talk about the vote and this, that, and the other. They don't want to talk about this fundamental issue. Just bear in mind, when you're buying a property, whether it's for investment or owner-occupier, you want to make sure that you understand the structure of the property. You've got to get a survey done. You don't just rely on the vendor Mickey Mouse marketing survey, right? Do your own survey to make sure you understand what you're buying. Because if you are buying a property with asbestos or something else wrong with it, that's going to be a huge impost. And quite often, the people that I've spoken with who've made bad decisions, they were there on day one, but they didn't know about it. So you want to get informed before you make a decision.
So when you say a survey, you're talking about a pest and building report. Is that different?
Yeah, exactly right. So it is making sure that you understand what are the defects in the property, and don't just rely on the the agent will probably have a vendor survey done. You pay 2 and 6. You pay 2 and 6 for that. It's a marketing document. It's not a serious piece of
Yeah.
work. If you're buying a property, and it doesn't matter almost whether it's a new one or an old one, you need to understand what the quality of the construction is. What are the defect issues that you've got? Because if you do have big defects, that can fundamentally change your calculation in terms of any gains that you might make. So it's really
Yeah.
important to do that. Also, check the planning and zoning in and around the area. Check the flooding. It amazes me how often people don't actually do any homework on the flood risk in the area. And there are lots of areas where property has been built on floodplains and flood very frequently. And that means you can't often get insurance, or you're going to get insurance at really big costs. So again, you need to put all of this information together before you make a decision. Don't just jump in because the property's there and it sounds a good buy. Do your homework.
I love that you pointed to those really fundamental aspects of property investing that are slightly boring. It's like, okay, I'm going to go and check the council website. Boring, but super important, because if you don't do those, you can really open yourself up to a lot of risk down the track.
And the point is, it doesn't catch you on day one, but it can catch you on day 2 and year 2, 3, and what have you. And like I said before, think about a 5 to 10 year horizon if you're buying property. Don't think about a 6-month horizon.
Exactly like what this person said. Damn, just popped a big one. The concept of diminishing returns. Net returns is what matters most, not gross returns. What are you left with at the end of the day? And the problem that we're having right now, just to round that out, is interest rates are at 6.5%. So there is no real cash flow positive property investing in this day and age. It just doesn't exist when interest rates are at this level. So there is going to be a portion of negative cash flow. So you need to look after the things that are in your control, like getting a better rate, getting a better negotiation on your property manager, and any other expense that you can control. The other thing actually that I realize, I do pests and buildings on properties. People, you can negotiate with the real estate agent. You have walked through that property and the pest and building has shown a water leak here, it's shown a structural issue here, and it's shown another issue here that you were not aware of. I got under this. You got under this contract at $650,000. Not knowing these things. So they need to come to the party. So you can push back if you have a pest and building clause in there. So that's just a tip that I don't think a lot of people are jumping out at. Let's just say you have unlimited money, but there is a market where there's value in this market. There's value in that. Like, what kind of price range would you be paying? What type of asset would you be buying? And what kind of location would you be buying in? That would be cool.
Before you answer
this is not financial advice, as it is every week. Not financial advice.
So this is my opinion, okay, at the moment. Houses rather than units. I wouldn't touch units. I've seen so many people get burnt, both investors and people buying for own occupation in units. The costs of the management of those units, the strata fees, the poor quality of construction, and the expected future costs ahead. Units are, I think, unless you are really, careful, a real risk. Houses with a little bit of land are going to hold their value better. They tend to through the cycle. There's significant demand. And, depending on where you go, the 800 to the million is for me a bit of a sweet spot at the moment, insofar that I think there's a lot of demand and there's a lot of capacity to buy in that area, and there's limited supply. And particularly in the areas where they're knocking down houses and building up, high rises and things, and a bit further out. So I would be looking at those inner suburban houses where there is still opportunity. If you can't afford that, come further out. I would say that regional areas are catching a cold at the moment, and I'm very concerned about people who've overbought in regional areas. And I think we're going to see more corrections in some of those regional areas. In terms of the different locations, Perth is nuts. Perth, though, over, as you said earlier on, 10 years, it's go back and look 10 years. There are still people underwater from when they bought earlier on. So even Perth is not a cert. Adelaide is quite attractive for interstate investors because of the price is still somewhat lower and still growth. Queensland is doing quite well because of the Olympics around Brisbane. But if you go further north up towards Toowoomba, Toowoomba is my worst postcode in the country at the moment. So I wouldn't be buying there. And if you then look at Melbourne, Melbourne is, listings are rising, prices are slipping, more properties coming on the market. So the greater Melbourne region is not an area I'd touch.
Interesting. And then it just comes down to markets within markets, right? You can still make money in Melbourne. You can still make money in Toowoomba. You can still make money in regional. You still can make money, but it's picking the eyes out of it.
You've got to buy at the right price. And remember that vendors still have a very accelerated view of what they think their value is worth. The typical gap, typical gap between asking and settle has now expanded. It's between 8 and 10% on average in many areas.
So what they list the property for, and then when it goes through to settlement, it's 500,000 is now 550,000, and it's kind of that has
it's dropped down from. So in other words, the asking is higher than the settlement in many areas. We're now starting to see settlements. Wasn't happening a few months ago, but it's now beginning to happen. And if you look at some of the latest statistics, the discounting that's going on. But vendors aren't still happy to discount because they think their property is still worth what it was a few months ago. So I think we're at a bit of a pivot point, and that's why I'm saying, ahead is going to be very, very, very interesting.